how can we offer amenities, right, in a low cost way? So it doesn't seem like an amenity, but bike racks, right? Bike racks is a great way, making sure that you've got a decent amount of storage. We also would go in and what we have done is we've gone in and we've looked at the laundry facility itself, upgrading the washer dryer for the laundry mat or the laundry servicing area, and then we start having the conversations about, hey, we're this is what we're doing. This is our plan. We're going to be coming in and raising rents, and then start talking to them about what those rent increases will be. And then we also give them the opportunity to opine with us and to come to the table and say, hey, that's fine, but here's what's not working in our unit. Here's what's not working in the common spaces. Giving them kind of a town hall type environment to do that in a way that is semi-controlled, so that way things don't get out of hand.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Karl Krauskopf is a corporate strategist turned CRE entrepreneur. Karl, welcome to the show.
Thanks for having me. Super excited to be here.
Absolutely. The pleasure is mine, Karl. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell us, where did you start? Where are you now? And how did you get there?
Sure. So 10 years, corporate strategy, business development, scaled a $50 million business services company into $150 million before we started prettying up the pig to go to market and sell. At that time frame, I started looking at alternative investments, alternative vehicles to wealth generation, got turned on to real estate, small multifamily, duplex, bought a duplex, moved into single family flipping, and fell in love with it. I really did really well for a couple of years, and organically grew an investor group. Folks were just, hey, I'd love to get involved in real estate. I don't have the time, have the money. So I started working with a couple of investors, one-off, and then that grew more or less out of control, where we had too many investors, not enough deal flow. So then I started looking at what's the next evolution of CRE, getting into ground up construction. Same problem happened there, and moved into multifamily now, where I'm at, and will continue to be for the foreseeable future. And I live in Seattle, Washington, and looking at continuing to be opportunistic in Washington, but more so looking to plant the flag in North Carolina.
Okay. Cool, man. I love it. I love the kind of process that you've moved there through each phase along the way. You organically grew an investor base. That is something that is probably one of the more challenging pieces of the puzzle for new and beginning commercial real estate investors. What were some of the things you did to, as you put it, organically grow that base?
Sure. So just it was unintentionally being in front of people, going to network groups, being on social media regularly, and again, just having decent relationships with family, friends, and with people specifically in the Seattle market. Seattle, obviously, being a high tech, high salary kind of employee base or employee market. So relatively easy to find individuals who had the liquidity to invest, but again, didn't have the time. So again, just flipping. This is my story. This is what I'm doing. And, we were at the time, this was, started about four years ago. This was at the time where, we were in a great bull market. So we're coming into obviously different times, right? We're starting second quarter of 2023 right now. And things are quite a bit more bearish than they were 4 years ago. So it's a little bit more difficult, and you got to be a little bit more on top of it going forward.
Yeah, absolutely. So in that 4-year window, 4 years ago, you were doing fix and flips and ground up construction. And so you've exited everything you've done ground up is now built, sold.
Yep.
Got it. Wow. Okay, cool. Is ground up something you would do today?
I'd opportunistically look into it. Now, I say that, and I'm also looking at my ground up construction in my backyard right now. So building a detached ADU backyard cottage, 1,000 square foot here in Seattle, Washington. Seattle does allow us to separately parcel off and create condominium associations on single family lots. Cool. So what I'm doing right now, building up ground up construction, 1,000 square foot, getting separate financing and going to hold it long term, where I'll be making certainly a 1%, that proverbial 1% rule, where my cost of construction is less than is 1% of the rent, essentially. So
Right. Right.
um yeah, no, it's going great. Still love it. So I would still look at it, but right now I don't think I'm as bullish on it as I was, let's call it a year and a half ago.
Right. Well, and it sounds like, the project in your backyard is a convenience project and not something you're looking to scale that side of the
Right.
business necessarily. So, I mean, that's
Right. Yeah, no, that's exactly right. So it's a convenience, it's a low risk.
right.
Right. My cost basis is the construction itself because I own the land already.
Right.
Yeah.
Right. 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 Yeah. You're not taking on the large scale development risk, maybe that some other people who are either. I mean, I get it on both ways on this show. Some people are like, no, now's the time to do ground up development. They'll give you a compelling reason why, and you'll hear the next person say, no,
Yeah.
here's why you should run. So I think that's really, really interesting. Focusing in now on the multifamily space. I ask this question all the time. We've got a couple of multifamily projects, but it's not something I focus on.
Sure.
And so I guess I just want to hear your state of the industry, maybe, and then, or hear what you think the state of the industry is, and then, maybe how you guys are finding opportunity today.
Sure. So I think rents are obviously flattening out. We're starting to see that here in Seattle. We've seen, I would even venture to say, close to dipping of rent prices.
Mm.
And I think that's obviously poses the biggest threat right now. I think also the other threat is regulations around affordable housing and requirements from the city municipality, which is one of the big reasons why I am looking at elsewhere outside of this market.
Yeah.
Affordability regulations, as well as, and I'm talking more so hyper local market, not necessarily the national market, because I do believe in a nutshell, real estate is all hyper local. And I think the other one obviously being is Seattle specifically, just in Washington in general, just doesn't have the availability of Class B, Class C type properties where you can go in and scale a sizable business, right? Back in the 60s, 70s, 80s, Seattle in the Washington state was they just weren't building these 100 to 200 unit complexes, whereas you look at any of the Sunbelt markets, you've got plenty of stock in that Class C, Class B, 100 to 200, 250 unit complexes that are still getting traded at decent cost bases here.
No, that makes a heck of a lot of sense. So where are you finding opportunity? Is it in that 100, 200 unit size of complex, or what are you hunting right now?
Sure. So hunting two different spaces, or two different types of assets in the multifamily space. It's the 30 to 50 range. So that proverbial and mom and pop size buyer, first time investor, first time multifamily a buyer coming out of their, hey, exactly where I was a year and a half ago, where I was kind of grew out of that development, grew out of that single family and mid-size small multifamily, and wanted to bite onto something a little bit different. And I feel that there is going to continue to be that buyer pool, and that buyer pool is not going to dry up. And that 30 to 50 range, you're still operating in such a space that doesn't require the quagmire of needing payroll but not having the operational budget to allow for it. And where you see that 50 to 100 unit range really falling into that, where again you need somebody on site, you don't have the money to pay for them, so you're having to be super creative in order to get what you need in a low cost way. Now that 100 to 200 range obviously is a little bit different, where you have the operational budget, you have the and obviously you need it, but you're also not necessarily competing just quite yet with the institutional buyers.
How or what are some of the challenges maybe you're facing right now on scaling properties in the 30 to 50 unit range?
I would say it's finding solid a property manager who's got a good control over in-house construction, repairs and maintenance construction. So they actually either A, own, or B, they employ some form of in-house crew, and also have decent relationships with subcontractors and know how to manage those subcontractors and know when to outsource that. So I think that's one of the big challenges from a scalability standpoint
Yeah.
that anybody will face when going into that 30 to 50 range. So it's imperative in finding again a property management company who's got the in-house crew and the relationships, and essentially a project manager to be able to manage those subcontractors.
Is your strategy to acquire, several of these in a specific area, so then you can have your own in-house asset manager that's local, or what's the long-term strategy?
Sure. No, I think the long-term strategy in the 30 to 50 unit range is not necessarily to scale just in this space, right? In order to get to that 150 unit, you really need to be able to understand how to asset manage, right? And so I think a lot of the those 30 to 50 smaller multifamily ranges is going to provide the teeth cutting environment to be able to learn how to asset manage, how to property manage, even so that way when you do get to that space, it's going to be an effective transition into the larger scale, and beginning to have those conversations around, should I take on property management in house? Obviously, that's the next kind of several evolutions ahead of where I'm at right now, but it's certainly again a stepping stone in getting to that space.
When you're dealing with a 30 to 50 unit size, you're gonna be kind of amenity light. Would be
Yes.
my conclusion. I don't know anything in that space, but I'm just imagining that, like you said. So you've confirmed that. Okay, it's amenity light. What do you do? What do you do to meaningfully raise rents to, just to add? What's a value? I mean, let's see if I can find a question here. What's a good way to implement a value add plan in that range? Because if you can't offer amenities and things that kind of bring in the higher paying tenants, what do you do?
So first off, it's finding how can we offer amenities, right, in a low cost way. So it doesn't seem like an amenity, but bike racks, right? Bike racks is a great way, making sure that you've got a decent amount of storage and I guess I would say targeted storage, meaning if you've got a bunch of ones and ones and they're a small space, do you have the parking? Do you have a large enough parking space, a parking lot where you can add in, makeshift, let's call it makeshift exterior storage sheds. So looking at your unit mix, what can you do from a low cost perspective to add some amenities? Again, storage, bike racks, we love. Again, because these are, class C, class B type properties where, they're either in urban infill areas and they just don't have that type of product or that type of amenity. Again, bike racks, storage. We also would go in and what we have done is we've gone in and we've looked at the laundry facility itself. Assuming that they don't have in-unit washer dryer, upgrading the washer dryer for the laundry mat or the laundry servicing area. And that's been one area that, the tenants have really enjoyed and have really felt this value add that we're bringing in, is kind of sprucing up, making those general spaces more warm, more welcoming. And, so that way they're not getting off of work and scurrying into their apartments. They're more so walking in, they feel proud of the space that they're in. And then we start having the conversations about, hey, this is what we're doing. This is our plan. We're going to be coming in and raising rents, and then start talking to them about what those rent increases will be. And then we also give them the opportunity to opine with us and to come to the table and say, hey, that's fine, but here's what's not working in our unit. Here's what's not working in the common spaces. Giving them kind of a town hall type environment to do that, in in a way that, is semi controlled, so that way, things don't get out of hand.
Right. Do you think, and I'm again, I'm just projecting here, or maybe I'm imagining, is the tenant in a 30 to 50 unit size building, do you find that they're stickier tenants?
When I'm thinking about my tenant base right now on our Central Washington apartment complex, and the average tenancy there is a little over 3.5 years. So in my opinion, that's a pretty in obviously you don't have the data, so you can't see what the high end and what the low end is.
Sure.
High end is, we've got someone who's been there for 30 years, so you kind of discount them.
Sure.
And from a single year turn perspective, out of the turnovers that we're only getting about 10% of those are 1 year tenants. So we've got a pretty strong tenant base that's staying with us.
Yeah.
That's staying with the apartment itself.
That's a really compelling statistic, if you want to call it that. Or
Sure.
yeah, probably not the right word for it, but a 3.5 year tenancy. I don't know what the national average is, or even what the that local market average would be. But again, I'm just kind of imagining that in that particular, there's an advantage to what you're doing, I guess is what I'm getting to.
Yeah.
Is that the type of tenant that would like to stay in an amenity light situation, that can, obviously has a commensurate rent to go along with that, but also probably isn't someone that is moving a lot. It is probably a very stable tenant base. And I would think 3.5 years, is a pretty long tenancy, would be my
Yeah.
guess for an industry.
Yeah, absolutely. One of the big things that drives, in my opinion, length of tenancy is going to be your unit mix as well, right? Your studios, your 1-1s are going to be a little bit more on the transient side. This particular apartment that we own is a solid higher mix of 2s and 3s.
That's really, really cool. I love that. Let's talk about lending. What's the lending environment like right now on these types of assets?
Sure. So on the 30 to 50 unit range, especially here in Washington, 30 to 50 unit range are going to be relatively old. So they're going to be in the, predating the 70s back to the 1920s. And the issue with getting any kind of agency debt on that is you're going to have to do something that's cost prohibitive, which is seismic retrofitting.
Oh, wow.
In order to qualify for agency debt. So that leaves, either a bridge debt, which I am vehemently against, or recourse, local credit union, local banks, which is what we are using right now.
Got it. That's seismic retrofitting. Never heard that terminology, but it sounds like something that would be expensive.
Oh, it's a challenge and it's expensive. I did that with a single family flipping when we had to go in and do these big gut jobs and studs out remodels. And you're essentially having to go into your entire stem wall. So where the concrete, where the foundation meets the wood framing, and do these massive earthquake straps to make sure that the house is protected when it shifts left to right, and ensure that the house just doesn't topple. So obviously, I think in some of the developing countries, there's been earthquakes that have just completely annihilated cities and towns. And you look at kind of the reason why it's those earthquakes are shaking them side to side, and none of them are earthquake retrofitted.
Wow, that's wild, absolutely wild. Well, yeah, so let's avoid the expense of having to do seismic retrofitting. I'm sorry, I don't know anything about that, but that's a cool couple of words. Either way you look at it. Tell me about so we talked about the lending, the type of debt that's available on these. What's your grand strategy for you and how you're going to build your company in acquiring these assets?
So the question, again restated, is how are we growing our brand?
What's your long-term vision with this? I guess I'll just
Sure.
go ahead and just back right into what we talked about earlier or before we got on air, was that you said, hey, I'm doing this as a solopreneur. There's a lot of people that go out, they build their business, they syndicate it, they raise capital, they bring other people in. You want to take your business in a different direction, and I'd love to hear what that is.
Yeah. So right now it's all about how do I create the systems and processes to delegate and then automate some of those processes that, and again, you're looking at your deal flow, your underwriting, your closing, and then your effectively your asset management. So looking at it from a funnel in that sense, it's where can I plug in, where can I hire either local staff, local people that I've met from meetups, networking events here in Seattle, and even potentially leverage virtual assistants to help with, again, deal flow, underwriting are the two primary areas for immediate delegation and hiring team members. So right now that's my, as of April 2023, that is my number one focus in getting some folks hired and getting that process started. So that way I can bring myself up and focus on the capital raising, asset management.
Got it. I love it. Karl, you're doing some really cool stuff, and I have a particular affinity for the kind of exactly what you're doing. I think it's a largely overlooked space. I know you said it's a mom and pop space, which I think is I don't know, I find a lot of strategic advantage to finding those mom and pop spaces just from a lack of sophistication standpoint.
Right.
Anytime you can come into an industry like what you're doing, or this particular, a niche within an industry, and bring sophistication to it, it's a gold mine for those that are willing to go in and really roll their sleeves up and figure out ways to systemize and, like I said, just bring sophistication to the space.
Yeah, absolutely.
Very, very cool what you're working on. If you could give our listeners one piece of advice, maybe something you've done right or something that you've done wrong along the way that you can help them either repeat and or avoid, what would it be?
That is a great question. So I think the number one piece of advice is, understanding what your end goal is, right? Why are you doing this? It's the proverbial why, of course. Family, being able to have that, for me, it's having that legacy, being able to go wide and go deep in terms of a legacy, being able to offer not just to my family, not to my friends, but also to the community, and having and bringing, comfort, right? For me, growing up, it was, I was in a little bit of a challenge situation. I was blessed. I had great roof over my head. But understanding that there were people that worked with my family from a landlord perspective, if I have that opportunity to do and bless somebody else like that, that's what I want. I want to be able to bless families as much as possible.
Man, that's awesome. Karl, thank you again for coming on the show today. I certainly appreciate it. I learned a ton from you. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
I love LinkedIn. I'm on there daily. So come follow me, Karl Krauskopf, on LinkedIn.
Awesome. Fantastic. We'll make sure we link to that there in the show notes. Thank you again, Karl, for coming on. Certainly appreciate it.
Cheers. Thank you, guys.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.